Hello everyone, this is P.Anitha, Assistant Professor, Department of Commerce. Let's see the case study from the subject is financial reporting. IFRS stands are a set of accounting rules for the financial statements of public companies that are intended to make them consistent, transparent, and easy comparable around the world. XYZ Corporation, a leading manufacturer of electronic gadgets, is contemplating an expansion strategy to enter a new international market. The company management has identified a lucrative market in Southeast Asia and wants to establish a subsidiary there. However, they are concerned about the financial implications and risks associated with the expansion. What financial considerations should XYZ Corporation take into account before expanding internationally? Let's see one by one. Market research, considering through market analysis to understand the target market demand, competition, and potential profitability. Next one is foreign exchange risk, evaluating currency risk and adopting strategies. Next one is regulatory compliance, understanding local tax law, import export regulations and requirements. Next one is capital budgeting, assessing the initial investment, projected cash flows and ROI for a new subsidiary. Next one is financing options, identifying suitable sources of funding for the expansion. The case study question is, company XYZ is preparing its financial statements in accordance with FRS analysis and impact of adopting FRS on the recognition and measurement of leases compared to the previously used accounting statements. Let's see the answer is, understand the previous accounting standards. Leases were categorized as operating leases or financial leases. Operating leases were not recognized on the balance sheet and lease payments were treated as operating expenses in the income statement. On the other hand, financial leases were recognized on the balance sheet with both an asset and liabilities recorded. With the adoption of FRS, significant changes have occurred. The lease accounting FRS under the 116 leases mandate that lessees recognize most leases on the balance sheet. This means the almost all leases, including operating leases, required recognition of the right of use asset and a lease liability. The impact of the change in the previously of balance sheet operating leases now have been recognized, thereby affecting key financial ratios and the financial positions of the company. Under FRS, lessees initially recognize a right of use asset and a lessee liability on the balance sheet at the present value of the lease payment. The right of use asset is amount over the lease them and the lease liability is reduced as lease payment are made with interest expenses recognized on the liability. Consequently, there will be an impact on the income statement due to the amortization of the right of use asset and the recognition of interest expenses related to the lease liability. Disclosure about leases have been more detailed and executive under FRS. Required additional information in the financial statements, such as maturity analysis of lease liability, weighted average remaining lease them, and weighted average discount rate used to calculate lease liability. The conclusion is the adoption of FRS has led to significant changes in lease accounting, mandating the recognition of most leases on the balance sheet, affecting financial ratios and requiring most effective disclosures in the financial statement. Thank you.